Investing can feel super complicated, right? It's just full of confusing jargon and so many choices. But what if I told you there's a simple, really powerful strategy that's perfect for pretty much everyone? Today, we're going to pull back the curtain on one of the best tools out there for building wealth, the index fund. Does the whole idea of picking individual stocks, trying to analyze charts, and timing the market just make your head spin? Yeah, if that's you, you are definitely not alone. It's a super common feeling. But the good news is you absolutely do not have to be some kind of Wall Street genius to make your money grow. So, what in the world is an index fund anyway? Okay, think about it like this. Instead of going to a restaurant and stressing about picking the one perfect dish, you just order a big sampler platter that gives you a little taste of everything on the menu. Well, an index fund is basically that, but for the stock market. It lets you own a tiny slice of all the big companies in a major index, like the S&P 500, so you're instantly diversified. And look, this isn't about being glued to your screen, trading stocks all day long, not at all. The whole idea here is that it's passive. It's a low-effort approach that's really designed for steady, long-term growth. You just kind of set it up, and then you let the market do all the heavy lifting for you over time. Okay, so that brings up a really good question. Why has this strategy gotten so popular? What's the big deal? Let's dive into the why and break down the massive appeal of index funds. Let's talk numbers for a second. Performance. Now, of course, past results are never a guarantee of what's going to happen in the future, but historically, big market indices like the S&P 500 have delivered average annual returns somewhere in the ballpark of 7 to 10% over long stretches of time. That really just shows you the power of betting on the overall growth of the economy. And this is where you really see the difference. When you put them side by side, it's so clear. With index funds, you get that instant diversification, which is huge because it spreads out your risk. Plus, they have super low fees since they're passively managed. No one's sitting there making a bunch of trades. On the flip side, trying to pick individual stocks, that's way higher risk, takes a ton of research, and often comes with much bigger fees. Yeah, the difference is pretty night and day. Okay, and here's the part that's kind of magic. It's a concept called compounding. This is where the money your investment earns actually starts earning its own money. Seriously, think of it like a snowball rolling down a hill. It just gets bigger and bigger all on its own. It's one of the biggest secrets to building real wealth over the long haul. All right, so let's say you're on board with the why. But here's the thing. Index fund isn't just a one-size-fits-all thing. There's a whole world of choices out there, which is great because it means you can find a fund that lines up perfectly with whatever your financial goals are. It really just boils down to this. What are you trying to do? Are you saving for retirement way down the road? Or maybe you want to get a piece of the global market? Figuring that out is the first step. Let's explore some of the main categories. So let's just run through the main flavors here. If you just want to own a little piece of the entire US stock market, a broad market fund is a fantastic choice. If you want to invest in companies outside the US, you look at international funds. Maybe you're really into tech or healthcare. Well, you can pick a sector fund for that. And if you're looking for something a bit more stable, you can check out bond funds. Let's just zoom in on one of those for a second. Market cap funds. All market cap means is the size of the companies you're investing in. So large cap funds, they hold the huge, stable companies. We're talking about household names you already know. Small cap funds, on the other hand, invest in smaller, up-and-coming businesses. They have a ton of growth potential, but they also come with more risk. And mid caps, they're right there in the middle, giving you a nice balance of both. All right, we've talked about the what, the why, and the which. Now for the fun part, the how. How do you actually get started with all this? I promise it's way simpler than you probably think. Okay, first things first, you need a place to actually do your investing. That's a brokerage account. And when you're picking one, there are a few things to keep an eye on. You want to look for low fees, right? Because fees will just eat away at your money over time. You'll also want a platform that's easy to use and, of course, has a rock-solid reputation for security. And honestly, the actual process, it is so much easier than you think. It really just comes down to these 3 steps. 1, you open an account online. 2, you pick a fund that fits your goals. Again, a broad market fund is a great place to start. And 3, you transfer some money from your bank and click buy. That's it. You're an investor. It's that simple. Now, there's this huge myth out there that you need like a ton of money to get started. And that is just not true. So many platforms will let you get going with as little as $100. Seriously. The most important thing isn't how much you start with. It's just that you start. But here's something you gotta remember. Investing in index funds is not a get-rich-quick scheme. It's a get-rich-slowly and steadily kind of plan. Real success comes from being patient, especially when the market gets choppy, and just consistently putting money in over many, many years. That's how you let that magic of compounding do its work.
So, there you have it. We've pretty much walked through the whole thing, from A to Z. The path is clear, it's simple, and it's totally accessible. The only question left to ask is, what's the first small step you're going to take to begin your own journey?